Thanks for having me here, and thank you all for coming and choosing to listen to faculty research instead of enjoying the nice rain outside. So I'll be presenting a paper on the market-wide effects of financial reporting regulation today. And the regulation of firms' financial reporting is quite pervasive and a crucial part of corporate regulation, usually thought of as important to generating and ensuring corporate transparency. In the US, for example, the SEC requires publicly listed firms to produce and publicly disclose audited financial statements. In Europe and other parts of the world, even private firms have to publicly disclose some audited financial statements. The economic rationale behind these widespread regulation is typically that there are some market-wide externalities to these reporting, which may lead some firms to privately provide too little of the public disclosure and the auditing, because, for one, you can imagine that firms don't take into account that their disclosures help others to evaluate their peers, so that's an externality they don't take into account. And often firms are reluctant to disclose their financial statements because they have some proprietary information in it which their competitors could use at their expense. And so firms themselves don't want to disclose. But if you're looking at it not from a private perspective of the firm, but at the market level, it may actually be good to share that information. So one firm's private information cost or proprietary information cost may actually be another one's proprietary information gain. So it's not clear that you would want to withhold the information there from a social perspective. Interestingly, however, while a key argument for regulation is at the market level and its broader effects here, we have very little evidence on the market-wide effects of financial reporting regulation. In particular, most prior studies usually focused on the firm level, where they are comparing regulated with unregulated firms, but this kind of comparison, by its very nature, neglects any of these externalities which you would have accruing at the market level. So what you really want to have is a market level design where you rather compare a more versus less regulated industry and see how that affects then at the market level, at the industry level, for example, the resource allocation. That's precisely what I am doing in this paper. In particular, I'm investigating how forcing a greater share of firms in an industry to either publicly disclose a full set of financial statements or to obtain a financial statement audit, how that affects the way in which resources are allocated and the efficiency of this allocation in the entire industry, so not just among the subset of regulated firms. To clarify a bit here, why am I looking at the industry level now? Well, that's my attempt to get it away from the firm level and one step closer to a relevant market. Why do I think the industry level is a relevant market definition? Well, most of the spillovers we would expect to occur within a given industry because one firm's disclosures is useful to evaluating its peers in the same industry, not so much to evaluate other firms necessarily, and similarly, within industry competition usually will benefit most from each other's disclosures. Now, why am I differentiating here the way and the efficiency of the resource allocation? Well, these are a bit distinct insofar as we have a clear ex-ante prediction what would happen if we force more firms to publicly disclose financial information and to have this hardened, so have that more reliable due to audits. We would always expect that this reduces information asymmetries and everyone can now just rely on this public information, so you don't have to have private channels with firms anymore, and everything becomes more market-like, more dispersed, rather than concentrated and reliant on private information. This shift from a relational to a transactional type of allocation, however, is not clear that this is associated with an improvement in the efficiency of the overall resource allocation. So that's then, in the end, an empirical question, which I'll try to tackle in this paper. To investigate this question empirically, I turn to the financial reporting regulation in Europe. This regulation mandates the reporting and auditing of financial statements of both publicly listed and in particular private limited liability firms. These firms must typically prepare and publicly disclose a full set of audited financial statements. Exemptions from these reporting and auditing requirements, however, are granted to some smaller private firms. The rationale for these exemptions is simply that there are some fixed costs associated with the regulatory requirements, so the exemptions are supposed to alleviate smaller firms from excessive regulatory burden. Typically, the exemptions are tied to a combination of total assets, sales, and employees thresholds, and typical reporting exemptions allow exempted firms to merely publicly disclose an abbreviated balance sheet at the level of current liabilities, long-term liabilities, shareholders' equity, abbreviated notes, that's it. And typical auditing exemptions allow exempted firms to forego a financial statement audit. Just to briefly illustrate the disclosure part about it. So this is a UK firm in 2014. It was below the exemption threshold, so it can file abbreviated accounts. And what you see is simply, well, an abbreviated balance sheet, a couple of notes, overall 4 pages of information. The next year, the very same company is above the exemption thresholds, and suddenly you see more than 20 pages of information. You see a strategic report where they have to discuss their investing behavior, etc. You see a profit and loss account, and so lots of useful information for competitors, but also for everyone else to evaluate the firm and contract with the firm. Now, in my research design, I explored the different thresholds for auditing and reporting across the countries to measure the scope of financial reporting regulation as the share of firms exceeding a given country's reporting thresholds in a given industry. So that would be just the share of firms above the thresholds. The key benefit of this measure of the scope of regulation is that it not only varies at the country level as a result of differences in the exemption thresholds across countries, but also varies at the industry level as a result of differences in the firm size distributions across industries. For example, a regulation exempting firms below 50 employees from auditing requirements affects labor-intensive industries more strongly than capital-intensive industries, because in labor-intensive industries, a greater share of firms will naturally exhibit 50+ employees and thus be regulated than in capital-intensive industries. Now, this is as technical as it gets in this presentation, so let's make it simple and just look at this regression equation. And what I'm actually doing here is I'll just try to explain some outcome at the market, country, industry year level, say aggregate productivity growth or product market competition. I want to explain that by reporting scope, the share of firms exceeding a given country's reporting thresholds in a given industry, and auditing scope, the share of firms exceeding a given country's auditing thresholds in a given industry. There's a couple of features to this design which are quite useful. First, I can look at and only use here variation within the same country and at the same point in time. Why is that useful? Well, we usually know that there's lots of differences in regulation across countries, so you could go ahead and compare just across countries, but there are lots of other differences across different countries, so you usually want to hold those differences fixed and go ahead and look within a given country. So then the usual pattern is you go in a given country and look over time if there's been a major reform. The issue with that approach, of course, is that, well, there are not that many reforms of the reporting requirements in any given country. And often enough, these reforms come at a time as a reaction, for example, to crises or changes in economic conditions. So why do we have the SEC disclosure mandates and the SEC to begin with? They were instituted in the 1930s as a result of the stock market crash. So it's then again problematic to just look around these changes because lots of other things usually change around these major reforms. The nice thing here is I can look within the same country at the same point in time. Then I also use a fixed or standardized firm size distribution per industry across all countries in calculating the percentage of regulated firms. Why is this useful? Let's just imagine I would not do that. That means I'll just go ahead and look how many firms in a given country, industry, and year are above a given threshold. And now let's imagine there's growth in that industry, so more firms grow above the threshold. So you see a higher scope, higher percentage, and growth in that industry. And in my regression equation, I would then kind of infer, well, the reporting regulation causes growth, while it was just the other way around. The growth was causing my reporting scope, for example, just to go up. So these reverse causality issues and several related issues I can get around with here. And then, as I alluded to very early on, this is a study at the market level, so at the country, industry, year level. The key benefit being that now you can get at the net effect of this market level. So in case there are any spillovers from regulated to unregulated firms or any reallocation between those, you'll be able to capture the net effect here. And lastly, this is a more cross-sectional design, as I said, which allows me to capture long-run effects instead of short-run changes just around the reforms of certain regulations. Now, with this out of the way, we can go to the data. On this slide, I have two goals. First, I want to get across how I will be presenting my results going forward from here. And I, of course, need to also validate my measure a bit. That is, I need to convince you that after taking this percentage of firms above a given threshold, you calculated using some fixed or standardized firm size distribution, that I still have some variation which really captures what I'm after, that is changes in reporting and auditing regulation or differences. So what you'll see here is just 3 regressions, and each of these rows is one regression where this is always the outcome variable that I try to explain, and here I'm plotting the t-statistics for the coefficients of reporting scope and auditing scope, and the t-statistics just give you a measure of how strongly the reporting scope is associated with the outcomes here, for example. To validate the measure, let's just, in the interest of time, jump to the last row here. What I'll try to do is explain audit, which is the fraction of firms in a given country industry year that exhibits the financial statement audit. What you see is increasing the share of firms that have to publicly disclose the full set of financial statements doesn't do anything to the share of firms that actually have an audit. We wouldn't expect that, and that's exactly what we're seeing here. But increasing the share of firms that have to get an audit strongly increases the share that actually exhibits an audit in the data. So this makes 2 important points. First, it says, well, I really have separate variation in reporting and auditing regulations, and it's capturing the variation that I wanted to, and overall these regulations and these thresholds seem to be enforced. Otherwise, this audit regulation wouldn't affect what firms actually do in terms of their auditing. Now, with that out of the way, I want to go to first looking at how reporting and auditing regulation affects the way in which resources are allocated in a product market or output market here. And what you'll find is that reporting regulation, again forcing a greater share of firms to publicly disclose a full set of financial statements, increases entry and exit rates, so increases business dynamism in an industry, and decreases the product market concentration and the dispersion of profit margins or markups. So all of that is suggestive of public disclosure really working as, or taking away informational barriers to competition, because now you better know where you should enter. Now you can always contract with the best firm and not necessarily with the only one you knew about before. And so this really looks like everything becomes more competitive and dispersed as we would expect. If we're looking at the auditing mandate, what does that do? I just find that it has a strongly negative effect on entry, and especially a stronger one on smaller firms. So that suggests that the auditing mandate acts as a fixed cost of operating, deterring entry of smaller firms. If we turn now to the effects on an input market, let's say the capital market here, I again find that reporting regulation has some significant effects, in particular on the share of listed firms and the average number of shareholders and the average ownership independence in the industry. Why would this be? Well, we know that one of the most important costs of being public is public disclosure requirements. So all these disclosure requirements that come with being public usually keep some firms from going public. If you now force more private firms also to already do the public disclosure, they clearly say, well, given that I already have to incur the costs of being publicly transparent, I can also go ahead and reap the benefits of greater capital market access by going public. So again, we'll see some dispersion of the ownership structures, more dispersed, more competitive financing here, while the auditing mandate per se doesn't seem to do anything here. Now clearly, I wanted to also say something about the efficiency now. What does it do to the efficiency of the resource allocation? Bad news to begin with. Well, there is no one perfect reduced form measure of the allocative efficiency at the market level. So I'm in the paper looking into several different proxies. And here I'll just briefly talk about one, which is the dispersion in revenue productivities. What's the idea behind this? Well, frictions and distortions in input and output markets usually lead to sustained differences in prices and technical efficiency observed across firms, even within very narrow industries. And so, for example, if there's a firm that has market power, it can charge higher prices than others in the industry. Or if there's a firm which has great political connections, it may still be operating, although it is technically not so feasible and would, from its productivity standpoint, usually drop out of the market. So these distortions, market power, political connections, all of that shows up in greater dispersion of revenue productivities. And so a measure you would see improved resource allocation efficiency as a declining or lower dispersion of revenue productivities. That's actually what you find with the reporting scope. So forcing more disclosure seems to, again, reduce this revenue productivity dispersion. And interestingly, this effect comes through reducing the upper tail of the observed distribution of revenue productivities. This is suggestive or consistent with the prior pro-competitive result I showed you. It suggests that those who looked very productive because they were able to charge high prices, those ones are reined in now. So if you used to be that only monopolist in town because no one knew how profitable your market is, now everyone knows it and comes in, so you're losing your market, your pricing power, and that seems to be what's driving this improvement in the static resource allocation efficiency. With respect to auditing regulation, all I find is that it increases the observed lower bound of revenue productivities. Why would that be? Well, again, this is very consistent with the entry results I found before, and is again suggestive that auditing mandates act as a fixed cost of operating. So the more you have to cover now the audit cost, the more productive you have to be to still decide to operate, because you always have to cover the audit costs. So worse firms are now, or less productive firms are now just not choosing to operate anymore. Lastly, I'm then also looking at aggregate productivity measures and growth measures. Notably, what I find here, or not find, let's say it this way, is that reporting regulation has a positive association with aggregate productivity growth. That's usually we care about productivity growth because that's a key driver of economic growth, and that's also usually why we like competition, because in the data it's strongly correlated with economic growth and productivity growth. But here I showed you the reporting regulation fosters more competition, but does not lead to productivity growth. If anything, there's a slightly negative effect here. How can this be reconciled? Well, I would have to speculate here, and I have another project following up on this to better get into the channels, but our conjecture so far is that the reporting regulation dissipates firms' proprietary information rents by forcing them to always disclose once they've found something useful. They'll have to disclose that they are profitable, so others come in and compete those rents away. So ex ante, you have less incentives to ever get informed about where's the best market or what's the best product to bring to the market. And so this is very, very much akin to the rationale for patent protection, for example. You want to protect some monopoly rents exposed so that firms ex ante have incentives to ever do some R&D. And that's what we conjecture is going on here. But that's work in progress. So overall, I find that reporting regulation fosters a competitive and dispersed type of resource allocation in both product or output and input markets, but does not unambiguously lead to more efficient resource allocation at the market level. In particular, it looks like reporting regulation substitutes a transactional type of allocation based on public information for a relational one based on private information. This substitution, however, does not appear to spur economic growth. And with respect to auditing regulation, I find that it primarily acts as a fixed cost of operating in my sample here, deterring entry, especially entry of smaller firms. So, thank you for your attention.